I've heard people say this is a set it, forget it trade because it just expires or you keep all the money. The problem is if it goes against you, you get burned. And again, if I'm looking at a 20% return, that means I have to be right 80% of the time just to be at a break-even point.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, two of my favorite guests are back on the line today. We've got Rance Mashek and Chris Mercer from MarketGear.com. Guys, thank you so much. Last week we talked about the poor man's cover call, really opened my eyes. And today we're going to be talking about bull put spreads, which is my very favorite trade that I basically has been my hammer in my toolbox, as you were telling me earlier, on pretty much, years. Just, I love the simplicity of it. I love the low maintenance of it. And so I'm interested in learning more and sharing that with the audience today. So thanks for coming on.
Glad to be here. Really enjoy sharing with you.
Yep.
You mentioned it, and we were talking a little bit beforehand. I think it's real important for us to bring up the hammer comment here. I'd said that when the only tool in your toolbox is a hammer, everything looks like a nail. I think it's a real important thing to have a variety of strategies in your toolbox, and you apply the right strategy at the right time. And this is one of those trades that, while it can generate a nice revenue, because it is a cash flow type trade, there is that gotcha if it moves against you, and you want to, be aware of that. So we'll talk about some of that, so to keep people out of the trouble that can happen in that at the same time. But it's a great cash flow strategy that can generate 10, 15, maybe as high as 20% in a month off of a position, as long as things don't move against you. Right. Mm-hmm. And we'll talk about the move against you and watching out for that, and how to kind of stack the deck in your favor a little bit as we go through this today. So pretty cool little strategy.
Yeah. And really the way that I look to do it, and I've mentioned this before on the podcast, is I love to find the back tested trend lines that perform the best, and then just basically move my put spread up as long as I can keep rolling it. Mm-hmm. And until that trend line gets broken, I can roll this for months at a time, and it can be a great little strategy to just consistently get, maybe about 20-25% returns, sometimes as high as 30% returns, depending on the stock, basically on a $5 wide spread, just taking those returns in week after week. But it's when it goes against you, Rance, that it can burn, and it can burn pretty bad.
Yep. And it's, and so there's two rules I'll share today on that to help with that. And because you're right. It's like, well, I'm making a 20% return every month. If I'm wrong once in a 5-month period of time, that means I'm at break even.
Yeah.
Right. And so and if you take that to a 10% return, now, you could be right, 9 times out of 10, and that one wrong can take you out. And then you mentioned something that I think is a real important thing here, about the call out risk. But I'll tell you what, or having it put to your risk. But I want to share that after we get into the strategy a little bit, because I think it'll make a lot more sense as one of the safeties here that you want to watch for as they get the structure of the trade. So with that, you want me to share a little bit of the?
Absolutely, yeah. Right. Go for it.
All right. So, first as we get ready to go in this, and I just feel it's a kind of responsibility here to mention this. We are going to talk about generating cash flow with a nice little cash flow on this with a bull put spread. But I do want to make sure that everybody does know that what I'm about to share, although we're using real market information and that to do this, this is for educational illustrative purposes only, not a recommendation for a specific trade. So I just want to be really clear on that. And what we're simply going to do here is an out of the money put spread. So rather than getting too far into the structure here, let me just take you right over to this is the Market Gear platform. You mentioned here a kind of important little piece on how you find these. And I think that's a very important piece to touch on, and we'll do that. I will tell you that I'm lazy on this. We have here our bull put spread, stock above 200-day SMA. There's 19 of them on the list today. That's what I do. And I'll tell you why I do it. If I go into this, you'll see immediately.
Just anything
here.
over 200? That's all you're looking for?
Well, no, I went over the 200-day SMA. No.
Yeah.
No, actually, if I were to go into this, there is a lot more criteria to this. That's just the name of it. There's actually 35 criteria on this to make sure that you do this. So, and I'll just tell you two real quick. Number one, there will not be an earnings report come out before the expiration of the trade, right? Because you're in a situation where if this thing takes a big hit, you're going to be hurting. So I don't want an earnings report that's going to come out before the trade, before the expiration that could drive that. Another one, which we've talked about in the past too, is dividend risk, right? So one of the things we don't want to have happen is a dividend. So that's also one of the criteria. So we want to make sure the stock's bullish. It's got a lot of positive outlook to it. You can see here on my technicals, pretty much most of these are all green, meaning it's a bullish or neutral bullish in its technicals. And then it also, other elements to that we want to make sure that that's the case. So what you were talking about, making sure it's in that trend line, it's above the trend line and keep moving up. That's absolutely a great way to go. I'm a little bit lazy in this, and I can go, with a click of a button, I can go in here and look at, I'm just going to go grab FedEx here real quick.
Well, not only that, but I mean, being that this is a platform, the people who are watching and listening can go and learn more at Chris Yule. marketgear.com/Chris Yule. That way you can get 50% off or 2 weeks free and then 50% off your first month. Man, I was trying to make a really smooth segue and I stumbled it hard.
That was well, I appreciate you letting know that. It's but it is so it's marketgear.com/Chris Yule, and we do have a very nice little special for you there. Besides 2 weeks free, completely nothing. Just take a look at it, and then 50% off your first month. And there are a lot of things in here besides just a regular, research platform. And, one of them in particular is this, the scans. And if I just go take this, I'm going to go grab FedEx here for a moment and just take a look at this. So go on my options trade. What you'll see here is this trade set up. So it came up in this particular case. It's actually doing a $10 spread, a 250, 260. There's a whole algo that figures out whether it should be a 5 or a 10 or whatever. In this case, it's coming up with a 10. But one of the things I think is real interesting on this, and if you look down here for just a second, we've talked about this on past things, but people that are used to seeing risk graphs, they're used to seeing a bull put spread risk graph that's going to look something like this here. Well, what we do is we spin it on its side. And we, by spinning on its side, we now match it up with the x-axis of the position itself. And now doing that, I actually I need to go and actually reinitiate that, because when I spun that, it gets rid of a little piece of information, because otherwise it would be inaccurate. So there we go. There we go. And so you can see here what this does is it actually draws over. So this is my profit zones, right? The light green's my profit. The light red is my max loss, and then the action in there, right? You can see that dark green and dark red is kind of where the action's happening. So if you look at this here, that's my break-even point, carries right over to here. That's my break-even point. You can see that this is below a support level, right? So you have this resistance popped up, tested it, going up. So that's below support. That's one of the really cool things about the strategy and the trade finder scan that we have for this is it's always going to look to do that and get that level of support. And in this particular case, what we're doing is we're bringing in $1.36 credit on this trade. So what we're doing, just so people understand this, so because I'm kind of going right into the numbers on it. So the current stock price, we're looking at the current stock price on FedEx is 277, and at 277, we're going to sell the 260. So we're $17 under the current price of the stock, and for that, we're bringing in somewhere in the near $3 range, because it's going to be between these two, right? So 266 to 335. So 280, 290, and they're a strategy out there, just sell naked puts, right? And this idea of, if I sell a naked put and the stock drops down, I'm buying the stock at a discount. Well, if you have the stock put to you so right now it's at 277, you sell a 260 put. If the stock drops to 240, I'm not sure why exactly 260 is a discount on 240. I realize it's a discount from where is today, but if it drops, you can get, you can take a hit. Well, the thing about this particular strategy, instead of being naked in this put, we're just going out further and we're buying a put for protection. So my risk now is only, I don't want to downplay the risk. It's still that full risk, but it's only that $10 spread. If it falls below 250, I can't lose any more. Right, where if I'm naked a put, you can lose all the way down. Right. So in this particular case, I'm selling that put, bringing in the cash for that, and then I'm buying another lower strike put. And I keep saying lower because the stock price, again, at 277, I'm going to sell below that. That's out of the money in the put world. Below the current stock price is out of the money. And so then I'm going to sell that, and I'm going to go even further out of the money and buy one, and that buy is that protection, so that I can't, I've got a defined risk trade. So now you bring in that credit, right? So you're going to use some of that money to go buy your protection, but net, I'm about $1.36 in the trade on a $10 spread. That works out to about a 16% return if the stock stays above 260. Again, it's at 277. We already have a $17 buffer in there. And we also have the added benefit of that line of support that we won't expect it to come through, right? So, and then at the end of the day, I can either let the trade expire, keep the entire $1.36, or another really good idea is as you get close to expiration, you may want to, like on that Friday of expiration, close out the trade so you don't have weekend risk. And we'll talk about that a little bit more in a moment. We both know people that have been burned by that. So I want to make sure we are very clear about the risk of carrying over the weekend. But that basically is a strategy. And I happen to grab one there on FedEx. The top one on my list here is Facebook. If I go look at this one, same thing here. You'll see that again. Now look at how low this one is, right? All the way down here for this, and this is a 22% return. So in this particular case, I'm still doing a $10 spread. I'm bringing in $1.79 credit on my $10 spread. My risk is only if the stock goes down below my 262, and right now I'm at 280. So I've got an $18 buffer on this before I even get into any level of risk in the trade.
And that's why I love these out of the money put spreads, is because it's like you can have like a margin of error, right. A pretty sizable margin of error. In fact, like you could think of it like a sports analogy. It's like maybe the current price is your quarterback and your offensive line is where your put spread is, right? You've got a decent amount of room until you hit the lineman in that regard.
Yep, you absolutely. And that buffer of space is really, really important here. Now I want to be really clear though, because you're bringing in $1.79. And if I go down here and look at this, I'm bringing in my max reward is $1.79. My max risk is the $10 spread minus the credit I took in, the $1.79. So I'm still at an an $8.20 risk per share, or $820 on a contract. So if I can make a 179 on 820 and a month, that's a pretty good return. But if this does move against you, you want to take action. This is I've heard people say this is a set it, forget it trade because it just expires or you keep all the money. The problem is if it goes against you, you get burned. And again, if I'm looking at a 20% return, that means I have to be right 80% of the time just to be at a break-even point.
Mm-hmm.
And so how do you stack that in your favor? Number one, you want to put this in. I personally always want to do the sell the option below my support level. To me, that's a real important piece on this and something to consider as you're doing it. So, and that's one of the reasons I like the scans to be able to do some of that stuff. So, but then, then as it goes toward expiration, you can then make a choice on how to exit it. Let me just give you a couple of things on that. First of all, if it breaks support, get the heck out of there. Right? Because what's going to happen is you notice here, if you look at this thing here, you see these lines, this dotted line and then the dashed line, that's the in time prices of this. So if this thing drops down, you can see here, I'm not going to lose my max gain until I get closer to expiration. If it breaks that level of support, I might be in a little bit of a loss, but get out. Don't wait until, so if I look at it breaking that level of support right now, I'm going to be down about $500 on this trade. Actually, if I bring up about,
and every day that goes by, it gets worse, right?
Right.
Even if the stock doesn't move, every day that you hold it and it's gone in the money, it gets worse. And,
Absolutely.
This is where when I blew up my account the first time and the second time, this was kind of what was going through my mind. It's like, hey, look, I can let this work against me. I can give it a few more days. I can give it a few more days. I can give it a few more days. And by the end of it, Rance, my account was gone, right? Because I thought I was being smart. I thought I was just letting it have more time to work. Some people even advocate for rolling if it goes in the money. I'm not in that camp. If it's breaking your support, if it's breaking your trend line, if it's breaking whatever line in the sand that you decided earlier, you got to get out. I mean, you got to take your losses. The more books I read, the longer I trade, the more people I talk to on the podcast, if you remove your emotions, you will be so much more successful. I mean, if we could just program in to a computer everything we ever wanted to do and then just walk away, that would be way more successful because the computer is not going to be emotional about it. You're not going to say, well, maybe I hope it'll come back tomorrow. I hope it'll do this or that. The computer's going to say, I mean, your criteria is met, move on. And, we're not to that point yet, but I do think at some point in the future, there will be ease of use to do sophisticated trading for the everyman. But until then, you just got to take your emotions out of it.
You're absolutely correct. And this is something I just want to share real quick that really illustrates this point. What this is the journal. Our platform here has a phenomenal journal, especially if you're trading options. I don't think there's anything in the industry that touches it for options trading. There's a lot to it, but one of the things that it has here is it keeps track of your win-loss ratio, both in a dollar amount and a percentile amount, right? So in this particular case, I have my losses, you can see this here, but my dollar losses are less than my percentage losses, right? You can see these little arcs here. And what that's an indication of is I cut my losses quickly. Mm-hmm. Right. If you let your losses run and, you had a situation where, like in that bull put, we had 20% and you let it go through it and lost it all, your arc for the dollar losses here would be, for the dollar losses here would be a lot bigger. And this is it's a simple little rule when we talk about with people when we use it in our journal is make sure your arc for your dollar losses is always less than your arc for your percentage losses. Cause if it's not, you're letting your losses run too long. And that's a real important piece on this particular trade in particular is that because if it does go against you, you can get a pretty bad hit here that you really want to consider what that, how you're putting up that position. So that's a pretty important factor in what we're doing here in this. So it's a real important thing to weigh out here. There's another thing, and you brought this up, and the stock that you saw this, you said you had a friend that was trading, was it Tesla?
Yes. Okay. So I watched a YouTube video. It was a guest I've had on the podcast before. His channel is called Project Option. And we talked about this during the time that I had him on the show. And his name is Chris Butler. And the the story was that somebody reached out to him and they had sold a put spread in Tesla and had let it expire, and it was on a Friday. Then after hours on that Friday, in the last 15 minutes or whatever it is, after hours trading, Tesla had gapped down and closed between his sold put strike and his bought put strike. So while he thought he was protected, because it expired right in between those, the sold puts got exercised,
which means he was forced to buy the stock,
and the bought puts expired worthless, and so he was out $30-something thousand on a trade that he thought he was going to have a max win within 20 minutes after the market closed. I mean, like, when I heard that, I was like, going forward, there is no excuse for not taking the remaining $5, $10, $15, $20 off the table, so you never have that risk at expiration. So that's my personal opinion.
Yeah, I'll tell you what, we had somebody that happened to that was in Amazon, same exact situation. They had a 10 contract, 1,000 share trade, expired with the upper strike in the money, at $3,000. You're talking about a $3 million trade, right? And it's they were just completely, this is a technical market term, freaked out. That's you're sitting there going, my max risk is X, and all of a sudden you got a $3 million $3 million worth of stock put. Now, mind you, they had to give you money to get the stock, so you did put out $3 million, but you got the price of the put. But still, the other part about that happens is now you have weekend risk, right? Because now it's whatever it is on Monday, whatever, so it could go down. So there's a couple things about this. Number one, if you're going to do this with anything that has levels of volatility in it at all, you really, really want to get out of that stock going into expiration. You do not want to run it through expiration. I will tell you that on a lot of cases, I will ride these through expiration, but it's not going to be on a Tesla or an Amazon. It might be on a FedEx. It might be on, like if I'm doing it on SPY, because that's a big bucket of stocks already, right? 500 stocks in SPY. So I do it on that, but it is giving up those few cents. Lets you sleep better at night. Lets you sleep better through the weekend, because that's what it is. It's the weekend risk. Right? I
never knew that could happen. That it would go after hours and be exercised and all that stuff. So that was a huge eye opener for me, because I'd never heard that story before. And I remember now, early on in my trading journey, I was watching different YouTube videos, and I remember watching one by Ally Invest, and it was when they were the Options Playbook, I think is what their site was. Yeah.
You had something to do with that, didn't you, Chris?
I might have, yeah.
Yeah.
Brian, a guy named Brian Overby it's his book. It's his, yeah.
Yeah. So there was one of his videos where basically, if I'm saying it correctly, I'm gonna try and do my best here. He said, "Don't be a cheapskate. Take the $5 off the table and close your trade before the options expire." And I was like, that's actually some pretty sound advice. So,
well, the other way to look at it, when you trade futures and you're trading corn or soy or something like that, you make sure you close out the contract before expiration, because you don't want a pile of corn showing up at your door, right? I mean, that's the thing. You don't want to take delivery on this stuff. Don't look at it any differently. You don't want a pile of Amazon showing up in your account, right, on Monday, and that's the same way to look at it.
Hey, my wife has a pile of Amazon showing up on my doorstep every day. So.
That's a different. Yes.
Actually, while we've been on the phone here, I got an alert. The $87.56 was charged to my credit card on Amazon. I'm like, oh, okay, she's shopping. Yep.
Yep, good point there. That's lovely. So when you're doing things like this, you definitely want to be cognizant of what you're in. So there's some rules that we have. I mentioned a couple of them on that scan, but you want to make sure that you don't have a dividend and you don't have an earnings report coming out between but before between the time you get in that trade and expiration, because those are just two things. I mean, dividend not as much, and dividends not paid out on Amazon anyway. But the earnings thing, man, the earnings can really swing a stock, and you don't want that to happen going into that. So that's a big one. And then the other one is if it's, I don't care what stock it is, if it's anywhere close, get out. And if it's a high volatile stock, get out. Period. And like the Amazons and the Teslas, and there's no reason to do that. If you're in, I know that one I've traded this a lot on is Adobe, and another one is United Healthcare. Both those are not, neither one of those are high volatile stocks, and they play pretty well. I'll ride those through. But again, if it's anywhere close to the level of support that I'm underneath, I'm not going to take that risk through that. And you're right. In fact, actually, when I was director of options at Ameritrade, back when they actually charged commissions for trades, now that we've gotten a world where that's not the case anymore, I managed to get through it at Ameritrade that if it was less than a nickel, don't charge a commission. They're not a contract fee or anything, not a ticket fee or contract fee or anything. And the reason we did that was we saw so many people, that would be up on that expiration, and they're cheap to buy them back, but they didn't want to spend the at that point in time, if you had a single contract, you were talking about, a $10.75, right? Because it was a 75-cent contract fee. And a $10 ticket charge. And, you'd have people off of that little bit of money, not want to close that out, and then end up getting burned by it. So I lobbied real hard and got that through at Ameritrade, where they didn't charge commissions on those closing trades because we wanted people to get out of them.
That
and
makes
we saw
so
many
much
people
sense.
burn through that.
I mean, like that's like when I first started, I had, I remember I was like, I can't make any money doing this, because I was selling iron condors, and it was one lots, and my ticket charge, commission, and everything in total, let's call it $20 round trip. And I'm making maybe $40-$50 round trip. I mean, like that, if I'm selling the iron condor like $1 wide, right? Things have changed a lot in my trading account. But let's say I'm selling a $1 wide iron condor, I might be taking in 40 cents. I'm spending half of it on commissions. And then if I'm closing at 50-60%, I'm literally not making $1 on this trade. And I was like, I got to change something. This is not working.
And a part of what we saw was there were a lot of people that were putting on things that, unless they rode through, just that between the bid ask spread going into that fluff that sometimes the floor maker, the market makers will put in that going in expiration, because they know you got to get out, right? If you want to get rid of that risk, and then the commissions on top of it, it just made it really difficult. So that was one of the first things I did when I became director of options trading there, was to get them to do that. And what we found out was, we really promoted that, and we found out that it was a lot less money for the firm to give up the commission than it was go chase down people with bad trades and try to collect, for stuff. It just and that's never a fun conversation anyway, no matter what, right? So it just from a customer service, a client care and everything, it was just a much better move to do. And now it's not even a concern, because it's like nothing for commissions, but it just really does illustrate the point, though. If there's any risk going into that expiration, get out. You got the weekend risk and expiration, man, because the thing is, it gets put to you on Friday night, technically it's by noon on Saturday, right? Now it's put to you, and now you have the risk of whatever it's going to open up on Monday. And if it gaps down further or whatever, it could be, even uglier, right? So definitely get out. If there's any volatility, any risk at all, you get out of these trades. Same thing here. We were talking about before. If it's moving against you, it breaks that level of support. Whatever your rule was on where you put that line, if it breaks that, just cut it. Cut it there. You're much better to cut your losses there, and have some left to play another day than it is to let it go down and end up getting hosed the whole way through. So
when your kids start driving, you tell them that nothing good happens after midnight, right? So the rule for traders is nothing good happens after expiration. Just don't be in it. Let all the settlement process be handled by people who have a whole different thing going on.
Yeah. That makes a lot of sense. Well, guys, this has been a really, really educational episode. I love being able to chat with you. Let's make sure we send everyone over to marketgear.com/Chris Uhl. That's me, CHRISUHL. That way you can get 2 weeks of Market Gear for free. and 50% off your first month of the Market Gear platform, which, as Rance was demonstrating here, is exceptionally powerful and is really a complement to your brokerage or anything else that you're using.
And just to be clear, that's a good point. It trades wherever you want to trade, right? We hook up to your brokerage. It's not the platform is just tools for you to be able to do, and a lot of tools in there for that, including these trade finder scans that help you find these opportunities in the market.
Yeah, this isn't meant to replace your brokerage. This is meant to assist you in making better trades and better decisions with the use of your broker integrated into it. So I think it's a really cool platform. I love being able to use it and learn more about it from you guys. So thank you so much for coming on and sharing this with us today.
Glad to be here.
Thank you.
And thank you guys for tuning in to today's How to Trade Stocks Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning on how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.